investors and traders, and welcome to the weekly market report with the market guys. I'm AJ Monty. This is a daily candle chart of the Dow Jones Industrial Average ETF, ticker symbol DIA, and the lines that you see on this chart are from last week's report when I drew this line marking the lower highs. I've also kept this support level in place so you can see where support and resistance are for the diamonds. And this is still my forecasted trend because I believe what's happening is the market will probably oscillate within this range for a little while until we see a breakout of the resistance or a breakdown of support. Now, in the world of technical analysis, a move below support is also called a breakout. It's not necessarily a breakdown, but I wanted you to understand the meaning behind what happens when a support level collapses. What happens is the sellers accelerate the market trend lower. We have stop loss orders that are usually built up below a support level as well. And when prices start to move below support, these stop loss orders are generally triggered, and we have a massive amount of market sell orders coming into the system because the stop loss orders are automatic execution set up by most trading platforms that are offered by the brokerage firms out there. So we still have a little bit of work to do in this area. I would not take any aggressive long positions even if we break over this high, because we still have high after high after high here in resistance, and as you can see at the bottom of the chart, we see the volume dropping. Particularly for this week, we see an accelerated drop in volume right there at the bottom, so that tells us that the move is weakening. Now, if you look at the Russell 2000, this is a more broad-based index. You'll see that we are still at a resistance high right here, with gaps below the market. These are the ones I identified last week. I'm leaving those in place. And as you can also see from the monthly chart, the Russell 2000 has been in a massive upward trend that is even accelerating. And believe it or not, the more vertical the move gets, the more bearish it actually becomes, because we cannot sustain prolonged vertical moves in any market or stock. So these are things that you really have to pay close attention to, especially when you're trading and managing risk. If you look at another index that I'm going to put in here, it's the UUP. This is the dollar bullish fund. It's more or less the ETF for the dollar. I'm jumping to this one right now because this is the first time in 20 years that we've had 9 consecutive up months in the dollar. Another thing that you see here on the chart is a gap below the market, which is not something you normally see in the dollar. There was only one other time in 20 years that the dollar actually gapped, and it was a gap down right here. Ultimately, the market filled the gap, and that was just a few months ago. And you know what happens after the gap is filled. A lot of times the market will reverse from there. So I'm expecting the dollar to drop. And we have an area of resistance up here at the top that we've reached last month. And you can see that we are really building a negative or red candle right here that correlates to the downward move in the dollar recently this month. Now, why am I pointing out the dollar? Well, the dollar correlates to the Dow. A lot of times when the dollar drops, you'll see the Fed step in to try to hike interest rates to support the dollar. So if we see a drop in the dollar, then that means interest rates or an interest rate hike is right around the corner. And we remember not too long ago, the Fed chairwoman Yellen came out and mentioned that June would be the month that they were thinking about interest rates and tightening at that particular point. So the bearish indication here in the dollar is also bearish for the Dow, and it's something that I pay very close attention to. You know, you could look at the spiders, you could look at the Qs. You're going to see, again, in these 20-year charts, accelerated trends that are on lower volumes. Again, I mentioned this last time, but I want to repeat this. This bullish market for the spiders especially is not being supported by higher volume. Look at the bottom of the chart. We're actually seeing a drop in volume as prices are going up. That's taken as a negative sign. Remember, we at the Market Guys pride ourselves on financial education. We don't want to spook the market and scare you out of investing. Of course not. There's ways to make money on the way down as long as you're preparing for the downward moves. There's so many things you can do besides lightening up on your position and moving to cash. You can turn around and learn options and learn how to buy puts. There's bearish funds that you can actually buy that go up in value as the general market drops in price. There's so much more that's offered these days, unlike what we had even 10 years ago, that it allows you alternative ways to invest without just moving to the sidelines in cash. I'm going to go back to the daily chart because I want to show you the Qs as well as the VIX. The volatility index is something that we look at as well as the Qs, and you can see this week it was really the breakout in the Qs, mainly sparked by Amazon. We had Amazon break out to the upside as well in a gap, but I mentioned to our Oracle subscribers the breakout and rally in Amazon was really a result of the analysts making an upgrade. And I'm very, very leery of that because I looked at the institutional report and Amazon is widely held by institutions. In fact, 83% of the float is controlled by the institutions. So they cannot just get out and sell without hurting themselves. They have to create demand somewhere else. So if they upgrade a stock, then the general public follows that upgrade, and guess what happens? The institutions transfer that risk to the general public, and now those like you and I are holding the stock at the top. The Qs are very much in the same position. I'm seeing a lot of overinflated prices based on institutional recommendations, and I don't like that. Yes, it's not illegal, but it's not regulated either. And I, in my book, look at that as manipulation, and I don't believe it's, again, this is my personal opinion, I don't believe that's an ethical thing to do, yet it happens all the time. And I'm trying to educate people on the manipulation that's going on and why these prices are so much higher than they normally would be otherwise. So the VIX, I mentioned the VIX, that's the volatility index. You can see that I'm leaving this line in place because I think that we have an area of support here. I could even adjust this down a little bit more. We still have a higher low from the low back here in December. I'm going to draw that just like that. And I still think that the VIX could rally, which would be bearish for the S&P especially. The volatility index is a contrarian indicator to the S&P. And we are on we're on 30-year lows for the VIX. And this is not a trending indicator. It's an oscillator that goes up, it goes down, but when it's low, it means the markets are overbought. And that's exactly where we are right now. Be sure to go to the Market Guys website where you can get free videos, educational videos and such. We continue to add to this library. We're changing things up just a little bit to give you some more value add. And one of the things that we're looking at is putting together a PDF document page or a library of PDF web seminars that I had done so that you can copy and download the PDF files and PowerPoint format so that you can learn that way. These will be for members only. It will not be open for the general public, but my partner Bill Shanley and I are working on that, and we're very excited to be able to offer that. Finally, make sure you register for the next open house. It's going to be May 18th. You can go to the front page of the Market Guys website, scroll down, and the registration link will be right there. It's free. You can invite friends. You'll be able to put stock symbols in this so I analyze them just like I did last Monday. And we have an action-packed hour of fun and discussion about the markets and how to make money. So that's our weekly market report with the Market Guys. Have a great weekend, and we'll speak with you soon. So long.